We're going to go through this segment by segment to what does it take to become a homeowner. And instead of taking questions at the very end, if you got questions as we're going along, it'll be really important because I really don't want you to forget what your question is if we're holding them to the end. The second thing is be aware that with a group like this, somebody else has got the same question in their mind, except they didn't raise their hand, okay? It's really, really important for me, and I think the folks here at Grand Prairie, that you walk away from here a really educated person on what is it going to take to buy a house. I talk to so many people every single day that are just lost as a goat, okay? And many, many times they've gotten with a realtor, many times they've already got about ready to put a contract in on a house, and they don't even know what they qualify for. They don't even know if their credit is in order. They don't know if their income is in order. And I can't tell you how many times I see a contract for, let's say, $200,000, and they're really only qualified to buy $150,000. Well, that is an emotional killer, if you know what I'm trying to say, unnecessarily. So today's process is to kind of help you out and take the steps. One of the biggest things is really getting pre-qualified from a lender. And with Supreme Lending, I've been in the mortgage business since 1990. This is not my first time around the bush. I've been on, when subprime was here, if you remember about subprime, I managed an office. Subprime was an underwriter and an office manager, and I've done thousands and thousands of loans, FHA, subprime, VA. Supreme Lending, our branch is in Northridge and Hills, but I'll give you my cards before we leave. We have a website. I have a website that you can apply online. You can call me. Our turn time is normally about 30 days. But the important thing is being able to talk to a loan officer one-on-one, face-to-face, and be able to get straight answers and be able to call them and talk to them anytime with your questions. Not to knock Bank of America or Chase or Wells Fargo or any of the major banks, but normally you talk to a loan officer and then you get thrown into a dark hole. And that doesn't happen with us. If it does, we're not doing our job. We need to be fired, if you want to know the honest truth. So, but a lot of times people are concerned that they don't have enough money before they want to start to become qualified. Money is not always the issue. Honestly, credit is an issue, and income is an issue. If you're, and the reason I say that money's not an issue is we offer the down payment assistance. You'll see in the other room, you'll see a number of flyers and things about down payment assistance. Now, admittedly, when you use the down payment assistance program, it will take at least $1,000 to get into a property when people think that it's 000. There is no 000 out there any longer. Admittedly, in my lifetime, in my life as being a mortgage loan officer, yes, I could get people in I've gotten hundreds of people in, but it's a whole nother lifetime. That was in 02, 3, 4, 5. Those years are gone. But the biggest thing is if you're just a regular employee, W-2 waged person, so you're hourly or your salary, we as a loan officer need to see, would like to see your pay stub and your W-2 and your tax returns. The reason tax returns are so important these days is the fact that many people have gotten extremely bad advice when they're doing the tax return because they want to pay the least amount of money to the IRS. I don't mind people paying the least amount of money to the IRS, so they have a small business and then they write off. I mean, I looked at one lady the other day who had $200 worth of income on a small business, and that year she wrote off $9,800 in expenses. Well, is that really right? Okay. But unfortunately, as a loan officer, I have to take that write-off and take it against their current income. She wanted to buy a $140,000 house. She could qualify with her income, but I had to take $728 a month off of her gross income. She no longer qualified because her tax person had said this is how you're going to save money on your taxes. Well, the difference in her taxes were probably going to be $300-400, but now she can't buy a house that she wants. She can buy a house, but it's much less than what she wants. So I caution people when we have to look at you from all sides. If you're W-2 wage, we look at the W-2, we look at your pay stub, we look at your tax returns to make sure there's not a write-off in your tax returns. We look at the 2106, which is how you write things off, like mileage or whatever. But it's important for you to be aware of what things we're looking at and looking for, and that's the reason I'm bringing this up. As far as income, if you're self-employed, that's a whole nother animal where we have to take your Schedule C, which if you're self-employed, you'd be aware that you normally have a Schedule C unless you're incorporated, and then we take your K-1s from your incorporation. But the Schedule C, we have to take the bottom line of Schedule C, add back depreciation, add back mileage, and average 2 years. Well, again, most self-employed people, they may have $100,000 worth of gross income coming in, and the bottom line, they show $5,000. Well, unless you had depreciation of $30,000 or $40,000, you're not going to be able to qualify for a loan again. So it's being aware of what we're looking at. Sometimes people say, well, you're not trying to offer me a loan. No, what we're really trying to do is we are lenders. We are not property owners, okay? We do not want you to go to foreclosure. The very, very last thing any lender in the United States wants you to do is for us to have to take back a property because you can't afford it. So we're being very, very careful on the front side to make sure that that doesn't happen, okay? And that has nothing to do with part of the neighborhood, has nothing to do with anything. It's just that we've got to be practical. We don't want that. It costs us almost 20%. When a house gets foreclosed on, it costs us almost 20% of what the loan amount is that we lose in taking back that house and remarketing it. There's no financial gain for a lender to take back a house. And I know on the street out there, the world will tell you, they just want my property. Well, just tell them they're wrong. I can assure you they're dead wrong. We deal with paper. Okay, we're like bankers. We move paper. We make money because we move paper. We don't want to move properties. We're not in the real estate business. We're in the lending business. So, excuse me for being so firm on that, but it's very, very important. Now, a couple things that income is important. Down payment wise, a lot of folks are looking at first-time home buyer programs. Well, FHA is really, truly a first-time home buyer program by design. FHA has always been the least amount of money out of pocket to get into a house. Right now, it requires 3.5% down payment. And conventional, to compare it to conventional is 5%, okay? There are, FHA is looser on the credit scores. FHA, we can start a loan app at 580. If your middle score is 580 or better, we can start it. We can do a loan. There's some caveats that I have to do on a low credit score, but still. And the interest rate is higher, and that's driven by Fannie and Freddie because the score is low. Okay, it's not driven by our company. It's driven by Fannie and Freddie. It's the overall marketplace. And what people may or may not understand, and again, as I'm skipping along here, Fannie and Freddie are how we underwrite too, because they are the secondary marketing people for all the loans that are closed on the street. In other words, I'm a lender, and just say I'm a little guy and I'm a lender, and I've got $1 million. $1 million sounds like a lot of money, okay? But in this marketplace, it may be 2 or 3 or 4 loans. Well, what do I do if I've got $1 million and I just loaned out that $1 million to 4 or 5 homeowners? I'm out of business. I have nothing else to do. So I've got to sell that $1 million to somebody else. If I underwrite the loan to Fannie and Freddie guidelines, I already have those loans sold, and I get my money back, and I go do more loan applications. So that's the logic. That's why you hear Fannie and Freddie out there so much, because they're the standards that we underwrite from, because we know we can stay in business. Because really, we don't make our living by just living on the interest rate, okay? If you know what I'm saying, the spread in the interest rate. We make it by what fees are charged or what we can sell a loan for, okay? And so that's an entirely different market. But I just want to bring up, why is Fannie and Freddie so important to everybody? And you hear that on the street a great deal, I just want you to be aware of why we do what we do, because we ultimately have to sell our loans. We're not a servicing company. We're a lender. We're an originating lender, and you're going to see that most people on the street are originating lenders. Okay. All right. If you put less than 20% down on the property, you're going to have one of two things. You're going to have MIP, which is the FHA insurance. So you're putting 3.5% down on FHA, and you're going to have MIP. Now, FHA, that's the insurance for the lender if you defaulted on that loan. That's not an insurance on your property for hail or damage or water or anything else. That's for the lender only that you're paying, because you're putting less than 20% down for the lender to take the risk to offer you that loan. Then in fact they want some insurances. And what the gist of MIP or PMI is the same thing under conventional, and it's just structured a little bit differently, but it's the same thing under conventional, that the lender will have roughly 12 months worth of interest paid directly to them while they're taking the house back and rehabbing it and getting it back onto the marketplace. Okay, so they're protected a little bit. That still doesn't make up all of the 20% that gets lost typically in a foreclosure, but it softens the blow is the best way to say it, for all practical purposes. So be aware, if you're not putting 20% down, which honestly 99.9% of the people don't put 20% down, so that's most of the rest of us, including me. As far as that goes, you will pay PMI. Now under FHA, PMI does not drop off except for when the loan is either refinanced or paid off. On MI, oh, excuse me. Yes, ma'am.
What's FHA and PMI and MIP?
Okay, FHA is MIP. MIP or PMI is the insurance that you pay with your note payment to ensure that the lender will loan you money when it's less than 20% down. Hopefully I'm being clear. Yes, sir.
What is it actually?
What does it say on the statement? Okay, he's asking, what does it say on the statement? It'll say private mortgage insurance. That's what PMI means. And I forgot what the acronym MIP means, but for FHA, but same thing, private mortgage insurance. It will say that on your statement, and it typically will be about, let's say if you're doing a $100,000 loan, it's probably going to be about $75, a month is what it's going to amount to. But it is on your statement. On conventional, once you have 20% equity in your house, it will drop off. You have to petition the people to have it dropped off. It doesn't automatically drop off. Once you know, and sometimes this happens in our marketplace right now, this could happen in 3, 4, 5 years under conventional, because we've had such great growth in certain segments of our marketplace that the appreciation on houses have grown such. Normally in Texas, we have about a 3% appreciation rate per year. So there's been some pockets in the Metroplex that have been growing 10, 15% in the last few years. So there could be an advantage there to go conventional if you think you're buying in those marketplaces. Yes, ma'am.
What if you get like Social Security or something like that, you can't buy a home?
Yes, we can work with folks on Social Security or SSI.
Yes, it's
We have to take what you earn just like we take what anybody else earns on a regular job. And if you are filing on your tax return, we have to take what's on your tax return. If you're not filing on a tax return because you don't meet that level of income that you're required to file, then we can add about 25% to that number for your gross income to make a comparison to what somebody paying taxes would do. So again, we look at everybody based on your credit score and based on your income. And so whatever, the truth's the truth. That's really where we're going in this whole thing.
Does it mean that I might not be qualified?
No, it's very likely you could be qualified, but it may not be the house that you want to buy.
But a house.
But it's a house. You know, in other words, if you make $12,000 a year, the max you can have between your debts and your house payment is 45% of $12,000 a year. Okay, I'm not thinking that out right real quick, but that's $1,000 a month. 45% of that is $550. So your house payment and your debts can exceed $550 per month. Now, that's house payment with taxes, insurance, and PMI in it. Okay, so to buy that house, depending on, let's say you've got no other debt. Okay, you got no other debt, or you got small charge cards, and so you got $50 worth of debt. So now that's $500 for house payment. That $500 for house payment equates to about a $60,000 retail price in a home. The question would be, do you want to buy a $60,000 house? That's not us saying you can't buy it. That's saying, do you want to buy it? Yes, ma'am.
Does it have to be in one of these locations?
No, ma'am. No, ma'am.
I can buy it here.
You can buy it any place. I'm licensed in 3 states. Buy in any one of the 3 states I'm licensed in, I'm happy to help you. Okay? I have 2 criterias. I tell people my main focus is working here in Texas, but I am licensed in Missouri and Oregon for odd reasons. But I have 2 criterias. Buy in a state I'm licensed in, and please do it before I retire. Okay? Those are my heavy-duty requirements, if you know what I mean. Yes, ma'am.
There's a house that I truly want. It's in Grandview. How much it is, I don't know, because I was waiting for the to check.
Mhm.
But it's still saying, it's not a new house, it's a used house. Would that make a difference?
No. She's asking if she's got a house in mind that's here in Grand Prairie and it's a used house. Does it matter if it's a new house or a used house? No. We deal with both all the time. Now, admittedly, the condition of the property is going to have something to say, okay? Now, if there's broken windows and there's holes in the sheetrock and the carpet is ripped, we're going to be asking the seller to repair those prior to closing, okay? Sometimes properties are sold as is. Honestly, those are investor properties because they've got some huge problem.
This one is sold as is, but it's nothing really wrong with it.
Well,
Just a little piece of
without seeing the property, it's a very, very difficult question to answer. The first step is to get pre-qualified by someone. And the second step is to find out what the seller is asking. And a phone call to the seller or to a realtor will then get you what they're asking to make sure. Because it's really, really awkward for you to like that house and be qualified at X dollars, whatever that is, but they want to sell it at Y dollars up here.
They want to sell it as is.
Well, as is has, that doesn't matter. All that tells me is the previous owner doesn't want to do anything to the property. If the property is in reasonable shape,
So it's at a real estate,
I'm sorry,
something real estate.
it's listed with a realtor.
Yes.
Okay?
Not
Call
by that owner.
call a realtor and find out how much it's worth. And then once you know what you're qualified for, make the two dots line up.
If I get that, you gonna give me the.
I give you the qualification. Yes, you got my card, give me a call. I can tell you within 10, 15 minutes. Okay. Here's my card.
And you pre-qualified.
Yes, ma'am. I pre-qualify. Yes, I pre-qualify you.
So that's all I need at this meeting, huh?
Yes, ma'am. Yes, ma'am.
Ma'am, you can
Excuse me.
actor as well on the website, so I
Oh,
was gonna say that,
go ahead.
ma'am, you can, I can give you my card, I can talk to you after this, and I'm real estate agent, so I can find out that. Because what happens is, you're getting your pre-approval with him, and then at that point, you need to find realtors to help you.
That is true. Yeah, that is true. And afterwards, we've got a limited amount of time, so afterwards, speak to either this gentleman or myself, and we'll certainly help you. But those are the two biggest steps, making sure you know what you can afford, and then lining up, finding a property that you can afford, okay? And so you, just so you're not disappointed, that's all. I mean, the emotional ride of buying a house is high. I mean, the emotional temperature for buying a house is high. And the worst thing to do is get your knees knocked out from you on the very first time you make an offer. And then you're so depressed that you don't want to do it again. And it's like, oh, man. Just know your parameters, know what you can do. And if it's not what you want to buy and it's not in the neighborhood you want to buy in, let's talk and figure out what it's going to take to get you there, okay? And I've talked many people through lots and lots of stuff. But know that when you're putting less than 20% down on a property, your payment is going to include principal and interest, taxes and insurance, PMI, and as a total payment. And it's all going to be escrowed, which means that the tax and insurance and the PMI will go, your payment goes to a servicing company. Now, that servicing company could say Wells Fargo, could say Chase, could be whatever. They're typically not the lender that loaned you the money in the very beginning, but they're the people that are managing the payment for that lender, meaning you're sending your payment off to XYZ company. The lender itself could be Chase Bank, and they send the principal and interest off to Chase Bank. They hold the tax insurance and the PMI, and then they pay that as necessary. So when your tax bill comes around at the end of the year, that escrow company is paying that tax bill for you. When your insurance renews at the end of the year, that payment is, that insurance payment is paid by that company, so that you don't have another expense. So at the end of the year, you don't have to also pay taxes, or at the anniversary date of your closing, you don't also have to pay insurance. It's all part of your payment. Insurance in the state of Texas is paid 1 year in advance. So at closing, part of your closing cost is paying 1 year's worth of that insurance policy forward. And then they collect 2 months worth of taxes and 2 months worth of insurance to put in the pad into the escrow. At closing, the seller is adding to your escrow account the number of months of taxes that they have owned the house that year. So at the end of the year, there's enough money in that kitty, that escrow account, to in fact pay the taxes. So that's the logic for escrows, and that's a word sometimes people don't quite understand. But in your closing costs, you're going to see that it's broken down in a number of different categories. There's lender fees, there's title company fees, and there's escrow fees. Okay, those are the three major. And the fourth piece to that is, what is the down payment? 3.5% or 5%. So closing costs of the three elements that I just talked about are plus the down payment, just to give you a quick idea about that. Again, if it's hard for cash to close, then we need to talk to you about down payment assistance. There's other ways to work with down payment assistance, or there's other ways to make a deal work. Sometimes you have bought a home that would be possibly appraised for more than what you've actually got a contract on. Let's say you got a contract for $150,000, but the marketplace in the area is $155 or $160. I can't tell you how many times when I've got a contract in, I've gone back to the realtor and asked them if we could add, say, $5,000 to the contract, and then have the seller pay $5,000, because you've now negotiated the contract. The seller knows what their net is going to be on the property. By you adjusting it, not changing their net, but helping you in cash at close, 99.9% of the time, the seller goes, hey, it's not a loss to me. But it helps my client, my buyer, get into the house. Well, that could help on closing costs. So there's multiple ways to help you through getting the cash that you need out of pocket without, yes, one of the ways is down payment assistance. 2 is re-looking at the contract. 3 is premium pricing. And what premium pricing means is that, let's say the market rate's at 4% right now in an FHA, which it is, or less. And we take and offer you, say, I looked at one yesterday, 4.5. You take 4.5. That changed this person's payment by $37 per month but brought them $2,500 extra to the closing table. We as a lender would bring that to the table. That made that deal work. The $37 didn't mean a thing to them because their income was in great shape, okay? But their focus was, get me in the house with the cash that I got. So as a lender, I'm looking at what is your personal hot buttons. Everybody has a personal need, or, I mean, none of us are 20% down, 750 credit scores, and lots and lots and lots and lots of money in the bank, okay? I see one of those a year, and I probably look at 500, 600, 700 people a year, so they're a small group of people that's out there that way. And often those people are second, third, fourth, fifth time home buyers. I mean, my son is a perfect example of that. He just closed on his fifth house. He's taken the equity of every home and moved it forward. He's in his late 40s, if you know what I mean. So there's situations that fall in that category. Let's see, what are we doing on time? So I can see where we're at. Oh, good, we're doing fine. Okay, the one other thing we talked about is credit score. A number of years ago, 10, 12 years ago, credit score didn't mean anything. We looked at your good credit against your bad credit and figured out a ratio, and sometimes we looked at only what was in the last 12 months, sometimes we only looked at what was the last 24 months. That whole situation has changed, and credit score is a driving thing behind our industry at the moment. Like I was saying earlier on, 580 is the entrance level to an FHA loan. And what I mean by entrance level is anything middle score. We pull from all three credit bureaus, TransUnion, Equifax, and Experian, okay? Pull from all three credit bureaus, and we're looking for the middle score of all those three bureaus. And the reason we're looking at the middle score is we know that one bureau may have all your good credit. One bureau may have all your bad credit. And so that's why we take the middle of the three scores. And we need that middle score on an FHA to be at least 580. Now, if you're not at 580, which I see a lot of people that aren't, or I see people that are, I've got one lady right now that her middle score is 586, and they got under contract. I had been working with her for about a month, maybe 6 weeks before she got under contract, and told her what to do to raise her score to at least 600 to 620. And the reason I coached her on trying to raise her score is the interest rate. At 580, we may be at 4 3/4. At 600, we may be at 4 1/2. At 620, I may be at 4. Okay, if you see what I'm trying to say. So there's a good reason to try to improve your credit. Well, she had done everything they've done, but it's been so recent that it hasn't moved her scores yet, and she's trying to close at the end of September. Well, what I'm going to do is, she's done everything, she's doing a couple other things. I'm not going to re-pull her score until like the 6th, 7th of September and see where scores are there. And then I have a process, if I think I can boost her scores even more, I have a process called rapid rescoring, which if they do what we ask, then within 7 days I can move their score up to whatever. I have a program that
How bad does it affect your credit score, or are you lending to someone if they were to, within that 6-month time frame, trying to buy a home, go try to buy a vehicle, or have a hard hit on the credit?
Well, hard hit on the credit is it depends on what it is that you're buying, and a lot of people are scared about hard hits. 1 point, 2 points, maybe on a hard hit. Mortgage hard hit, maybe 3 points if you're lucky. I mean, if at worst, I'm not saying lucky, at worst. But no, please don't go buy a new car after you've gotten pre-qualified. Don't go incur new debt. I had that. I was a builder many moons ago. I was a builder. Had been working with this couple for months, designing a house, choosing a lot. They'd gotten pre-qualified, whole 9 yards. And we're probably, actually, I think it was the day that we're planning to sign the contract and take their money and begin the build job, okay? He pulls up in this huge new dually, huge, brand new, and his wife is so excited about this vehicle and his car payment, and this is 20 years ago, was $900. So you can figure out how tricked out that vehicle was at that point. It had, and they pulled up and I saw this, and I got a little office there in the model home that I'm in, and I'm going, boy, I hope that's not a new vehicle. I hope that they're test driving it or something, if you know what I mean. And they come in, and his wife is just bragging about how neat that house is, that vehicle is, and blah, 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 and going on and on and on. And I just let her talk for a while. And I said, well, what's your payment? And at that time, their house payment for the product they're trying to buy from me was going to be $1,000. Okay? And I said, well, let me call the loan officer. Like me, I'm a loan officer. I had a friend that I worked with a lot, and I called him up and I said, hey, what happens if we add $900 to these people's debt? I said, ain't no way it's going to happen because their ratios are way too high. So I looked at her and said, well, you have a choice. You can move into your new vehicle, or you can figure out how to get rid of that thing and move into your new house. Well, I didn't hear from, and of course, that played out. It took 40 hour to play it out. I didn't just drop it on her, but I said, I don't know, there's nothing I can do. I can't consciously ask you to sign this contract because I can't get a pre-qualification letter from your lender. And she just depressed now. She came in on cloud 9 and she went on underground, if you know what I mean. So, I'm a builder, sitting there, same model, same subdivision, same everything. 6 months later, she comes driving up and she's got extremely used vehicle, okay? And I said, hi, how you doing? And blah, blah, blah. And I was just trying to be nice to her. And she says, well, I sold that vehicle, and if he buys another one, I'll divorce him. I want my house. I said, bring your husband by, we'll do it this weekend. And eventually built him a house. But to answer your question, that's how critical some of those things are. Yes, I know you want that vehicle. Please buy it. If you're going to buy it, the day after closing, okay? Because I don't look at you right up to closing. But I really don't want you to ever buy it because you're putting yourself in a very, very bad position. And I don't knock driving a brand new vehicle. I don't knock driving everything that's got bugles and whistles on it. But do it when it doesn't affect your family. This is family. Yes, ma'am.
I have a question. So, let's say that kind of circumstance earlier when we were talking about the grand closing.
Yes, ma'am.
How, for example, looking at a house that's worth approximately $150,000,
Mm-hmm.
how much should we even have to start before we even go to the process?
Well, honestly, it doesn't matter. If you got $1 today, that's fine, because it's pre-approval, and we're trying to coach you on how to get into a property, be this month, or I can't tell you how many people that I work with that when I first meet them or talk to them on the phone or however, that we don't close a deal for 3 months, 6 months, 9 months, a year. That's why, honestly, I say joking to you, all I care about is helping you close on a house prior to me retiring. So that I want to take the walls off of your timetable. And many people are, I've got to do it before my lease is up. No, you have to do it when it's right, okay? I don't know what's right for you until we talk to you. We can guess at it all you want. Your best friend can tell you that he just bought a house and it only took X, but your credit, his income, your income, who knows, okay? The people that you work with, the people that are at your office, the people that live in the apartment complex, the people you go to church with are great friends. They're lousy loan officers. Excuse me, and I'm not trying to be tacky, but every single one of you in this room I bet you if I took every single one of you and pre-qualified all of you, one or two might match up to be close to each other. Everybody else will have slightly different parameters, and that's not negative. Okay, we've got one lady in the back first, and we'll get to everybody.
I was working for a lender, and, for a realtor, and they told me that I was qualified,
Mm-hmm.
and my credit was good.
Mm-hmm.
And then when it was time for me to get my pre-qualified letter, she told me to go through another lender, and then my credit was not so good.
Well, what happened in the meantime?
Nothing, I don't know how the 30 points went.
Well,
went down.
I don't know why she sent you to another lender, except that she pulled your credit and it didn't work for them. There are people in the Metroplex that won't do an FHA loan at 580. They'll only do it at 600 or 620. I mean, I've been with those companies. But often, there's something that's happened in your credit that has hurt it. Some people don't realize, if you only have 3 lines of credit, and they're all small charge cards, not a car payment, but just 3 small charge cards, and you have one 30-day late, your credit score could drop by 50 points because your credit is fragile, okay? It's very, very fragile, and especially if it has no depth to it. 3, 6, 9, 12 months, that's fragile credit. If you've got a car payment in there or 2 car payments in there, plus 2 or 3 lines of credit, and they're all perfect, and you have one 30-day late on a charge card, it may only affect it by 3 or 4 points because you've got depth in credit. So they're going to be talking about credit repair here in this afternoon, but that's why to answer your question exactly, I need to look at your credit report, and I can coach you through exactly what happened. Did they ever give you a copy of your credit report? That's a yes, no. If you work with me, the 2 things I get from you are your telephone number and your email address. Shortly after I pulled your credit report, this may be 15 minutes to 2 hours, depends on how many phone calls I have or what's going on. But within that day, I'm going to be emailing you a copy of your credit report that you see who you are. And if you don't qualify at the moment, I mean, the scores aren't quite there, you're going to see comments all through that credit report. Get rid of this dispute. I'll send you a letter that tells you how to get rid of the disputes on the phone. You do it yourself. I used to do credit repair, okay? Not knocking credit repair guys, please. Somebody's probably in the room that does credit repair. I'm not knocking you, okay? But I learned a long time ago that when somebody signs up with a credit repair person, they believe that that's all they got to do is pay the bill. They don't have to pay their other bills. So their credit often, or the company dispute, which hurts. I'll coach you on fixing your credit, but it's all in your hands to do what I coach you to do, okay? If you come back to me 3 months later and say, Dan, pull my credit, the first thing I'm going to ask you is, what have you done? If you say, nothing, I'm going, what for? How are we going to be any different than we were before? Probably going to be worse. But if you say, no, Dan, I paid that off, or I did this, or I lowered the balance here, or I opened that new charge card, or A, B, X, Y, and Z, fine. No cost. I'm not charging a dime for the first credit report. I'm not charging a dime for the second credit report. I'm not charging a dime for the third credit report. I pulled credit reports 10 times for people prior to us closing on a loan. That's just the cost of me being in business. Okay, so if they're not sending you your copy of your credit report, I'd ask them why. They're going to throw something out to you by saying, well, we're not allowed to, or not what. Move on. Move on. They either don't know what, I shouldn't be saying this. They either don't know what they're doing or they're hiding something. And you don't need to have your information hidden. I'm sorry. That's just, now I'm speaking from my heart to you, how I'd like to be treated if I were standing in your shoes versus how some people are treated. I just don't, that's just me. So, and again, I'm not talking down other companies at all. That's just me. I want to tell you what I think. Yes, ma'am. Sometimes, if they're in a charge-off status, sometimes by paying them off, we can raise the credit score quite a bit. If they're just in a collection account, sometimes it's not effective. And it depends on the age of it. Typically, a medical bill older than 12 to 24 months won't have any effect on your credit score. If something just happened yesterday, any collection that just happened yesterday is going to hurt your credit score. Yes, ma'am. Yes, and her question is when any credit agency, medical or anyone else, you've got a collection account and you think that collection account's gone dormant, and it may even have dropped off your credit report, and then it shows up again. It shows up. They have the rights. The misnomer, yes, it will hurt your credit score when they put it back on the credit report. To answer your specific question. It will hurt your credit report. And the misnomer in the credit industry that's out here is after 7 years, doesn't matter what it is, it's going to drop off. That's the only thing that drops off after a timetable is a discharged bankruptcy. And after 7 years, well, 7 to 10 years, it'll drop off. A tax lien or a judgment after 10 years if they're satisfied. So in other words, satisfied, paid off debts, collection, paid off zero, a judgment, a tax lien, anything that's zeroed out, a bankruptcy is zeroed out, yes, they will fall off. But if it's a balance owed, you still owe money, that's a viable debt, and as long as it can be attached to you and your Social Security number, it will follow you to your grave. And the biggest misnomer in the industry is that it's going to go away. It is not going to go away. If you don't want to deal with it, that's your choice. But the truth is, the worst time in your world for that debt to re-pop up is the week before you're getting ready to close on a house, and if it's big, it could throw you out of the thing. If it's small, it may not hurt you at all. So I caution people on thinking that, oh, I've been told this, and this. Okay, the truth is, if it's verifiable debt, they can tie it to you and your Social Security number. And if the companies stay on top of it, then it will stay with you the rest of life. Now, a lot of companies blow it off. But I used to work with a company that bought huge packages of debt that were 4 or 5, 6, 7 years old. He'd pay $100,000 for $10 million worth of debt, okay, pennies on the dollar. Well, he had 3 people in there. All they're doing is collecting that debt, putting it back on people's credit report and collecting that debt. He made a huge living doing that, let me tell you. Excuse me, there was a question back here. Student loans, thank you. It's a great question because student loans just this year have become a very, very big piece of the puzzle. And historically, if a student loan was deferred, we didn't have to charge that against your back ratio. Currently, if it's deferred and there's no payment on the credit report, in other words, you owe $10,000 in student loans and the payment's $100. Okay, if there's nothing in that payment thing, we have to take 1% and charge that against you. That's both conventional, and FHA at the moment. And the reason is that if the biggest catastrophic debt the United States is getting ready to face in the next 3 to 10 years is the wave of unpaid student loans. And it's coming against, that's why the federal government has taken them all back in. The lenders have realized their default rate is so high that the federal government had to take them back in. As you can see, most student loans are now federal debts. 2 things that you can't get rid of in bankruptcy: student loans and IRS debt, okay? And there's a lot of people out here, I talked to one yesterday that said, oh yeah, I'm on a program that he owes $150,000 in student loans. He's paying nothing right now, and he said within 10 years, 20 years, I'm on a program, and it's going to be escalating. I'm going to pay a little bit next year, a little bit more, a little bit more, a little bit more. And at the end of 20 years, they're going to forgive the balance. I'm sorry. If you believe that one, I got something to sell you, okay? Because I'm scared, Do we really trust our federal government to do what they say they're going to do? Okay. Enough said, if you know what I'm saying. So if it's tomorrow, I'll trust them, but if not, yes, ma'am.
Is there any other first-time buyer program besides FHA?
Well, FHA is a first-time home buyer, then you pattern that with down payment assistance, because down payment assistance will not allow you to own another home at the time of closing. There's some that will allow you to have just sold a home, and now you can do it, but you can't have two homes at one time.
Now, the down payment assistance, do you have to have your credit, like, at a certain?
Yes, all the down payment assistance programs in the state of Texas, the question is, do you have to have certain credit criteria for them? Two things, the down payment assistance programs, all of them in the state of Texas, require 640 entrance into the middle score is 640. The second thing, the interest rate is set by the state. It is not set by us. It's not an open market interest rate.